All right. Well, thank you everybody for joining us this evening for our second webinar in our series on commercial real estate investing 101. And tonight we're going to tackle market selection and analysis. And again, what we're going to try to do is just give you that 30,000 foot view of what Brandon and I do when we're looking at a market. You know, we end up having other sponsors who find properties. They're wanting to have us join their team, assisting with anything from raising capital to, due diligence, asset management, just a number of different tasks. As you know, this is a team sport. So when they contact us and want us to come and help them and join them, we want to know what that market is. We want to be able to do a deep dive into it and make sure that it is a good, sound market that we feel comfortable investing in. So that's kind of what we're looking at doing this evening, is looking at the different market types, the market drivers, and understanding the potential for future demand in that market and how we do it. At any point throughout this presentation, if you have any questions, please put them in the Q&A. And at the end of the presentation, we'll be more than happy to answer them. But just some quick introductions. Again, I'm Mike Strodman with Blue Skies Equity. I've got a master's degree in urban and regional studies. I was previously a city planner and worked on all aspects of zoning and community development. I quickly realized, I loved real estate. That's why I got into city planning, but quickly realized that I was on the wrong side of the table. And I wanted to be the individual that was bringing these business plans to these communities and seeing these projects happen. So I've been investing in real estate for 15 years, and I've done a number of things, from buying and subdividing land, purchasing typically B or C class properties. A lot of times we'd buy a C class property in the B neighborhood, go through, do a total renovation inside, outside, and bring it up to a B class asset in a B market or in a B area. So, and then obviously always looking at cash flow through that. Also have done ground up construction where I designed the buildings and then some building. Also acted as a co-GC on those projects. And presently the portfolio has both a limited partner and as an owner is about 500 residential units, just over 500 units. And we also, the properties that I have here in my local market, we are vertically integrated for asset management and property management on those. So with that, I'll turn it over to you, Brandon.
Yeah, thank you, Mike. So I'm Brandon Gattay with By Design Capital. We're located here in Rapid City, South Dakota. And like Mike, I didn't start in the real estate world. I started in engineering and construction. So I have a dual degree in geotechnical or soils engineering, as well as construction management. I've spent the majority of my professional career more on the project management and construction side than engineering, and spent really the last 10 years in progressive leadership roles around project management and then into the business management side, most recently as a senior leader in a large international construction firm where I led a large team of sales, operations, engineering, and the like, in really helping grow that business from around 18 million to around $40 million annually. And in doing that, I really started to see the overlap between managing P&Ls, building out strategy, growing a team with what I was starting to do as I started to invest in real estate, and really started to see those synergies more specifically in the commercial realm. So really started to focus on that and have been shifting more that way. So I've been investing in real estate for the last 5 years or so. I started like most investing in single families. I've done some short-term rentals. I've done private lending, both with my own private capital as well as through retirement accounts. And most recently, again, shifting really almost completely into the multifamily space and into the syndication space. So my present portfolio, just right around $300 units total, majority of those being multifamily. I have a handful of single family still left, both as an owner and then as an LP investor. And the majority of those is as an LP in other syndications. So that's the perspective I bring. Although I'm on the active side now, I've certainly been an LP, and I know Mike has as well. So a lot of what I'll be speaking to is from that LP perspective.
And just as a disclaimer, the information that we are presenting tonight is just for informational purposes. So definitely seek legal advice or advice from your CPA if you're going to look at investing in any type of real estate. So just want to give the disclaimer.
Righty. So
turn it over to you.
Market selection and so market selection and analysis. Why does it matter? What is market selection? It's exactly what it sounds like, right? It's what is the main market that you're investing in. But it can go a little bit deeper than that also. It's not just the main market, the major metro, what's the sub-market down to the neighborhood. And it's important to really understand that when you're starting to look at properties, a little bit of both. You want to make sure the overall market's strong as well as that sub-market. And I love quotes, and I very much love Warren Buffett quotes. And this was a fitting one that he stated, when management with a reputation for brilliance tackles a business with a reputation for bad economics, it's the reputation of that business that remains intact. And really what he's saying there, and how it applies to the real estate side of things, is if it's the business, the management team could be great, but if the business is founded on poor economics, that business is still going to fail. When it comes to real estate, and really how it applies to the market analyses, is you can have the nicest property, you can have the best management team with a great business plan on paper, but if the market isn't sound, if the demand isn't there, or the tenant base can't support it and can't specifically support the business plan, you're in trouble, regardless of how great that property may look or how much you put into it. So that's why it's really important to be able to understand these, whether you're active or passive, right? So from there, we'll dive in a little bit deeper into what are the different types of markets that you might be looking to invest in. Here, let's see. There we go. So really, three different main market types that you'll hear: primary, secondary, and tertiary. So primary, it's exactly what it sounds like. It's the main. They're the big markets. You'll sometimes hear them called gateway markets. These are large, dense population centers, typically 5 or more million in population, with a long established commerce and industry. So these are New York's, Boston, LA, Chicago, those types of big places. Those are looked at as primary markets. So some of the pros of investing in these types of areas is, again, they have a long established economy. There's strong demand in these places most oftentimes. There's a volume of product. That means there's a lot of properties to buy, right? And there's, generally speaking, stability over the long term in these bigger markets. The cons, biggest one is they're expensive and competitive. I mean, those two go hand in hand, right? So typically you'll see large private equity funds, REITs, foreign investors, really large syndicators, really fighting in these markets. And that can drive prices up. They're willing to pay a little bit more and maybe take a little bit lower long-term return because that fits their business model. Whereas for the more average size, say syndicator or investor, they may be looking for higher returns. So it's tough to break into these markets. And then another con that's somewhat counterintuitive to the stability piece is, generally speaking, these bigger areas can be the first ones to feel economic shifts. So they can be volatile, stable over the long term, but they can have some larger peaks and valleys and typically feel it first. So you don't see it coming necessarily when there are those economic shifts. Next, we look at secondary markets. So these are just step down from primary, slightly smaller, generally 1 to 5 million people, less economic activity, but still strong economies. And generally, these are ones that you'll see as strong growers in terms of commerce, industry, and population. So you think of Portland, Minneapolis, Denver; those are generally looked at as secondary markets. They're more affordable than primary markets, but still fairly expensive, considering, but more affordable. Still established economy is a pro. Generally, the diverse industry. You can potentially get some higher returns than the primary markets, and a little less volatile when you do see those economic shifts. And cons, competitive. So really similar to primary markets, slightly less competitive maybe than primary markets, but still really looked at by a lot of the main players. So a lot of syndicators, some institutional investors, so competitive. And then lastly, tertiary markets. So these are your small markets, generally less than 1 million people, spread out populations, smaller urban centers, and generally have fewer amenities. But they do still tend to attract the renters and homeowners, generally because of affordability and quality of life. So these are places like Omaha, Des Moines, Rapid City, where I'm at. Those are all considered tertiary. And there's a lot of gray in between all three of these. Really, between secondary and tertiary, there can be some real gray, but these are just some high level things that help us decide what it is. Some of the pros on a tertiary market is they're generally the most affordable, and that's due to lack of overall competition, lower volume of products. You'll see higher cap rates, potentially higher returns. All due to that lower competition. Generally, these areas you're more apt to be able to source potentially off-market deals and maybe some seller carry or finance opportunities, and less sophisticated sellers. Then on the cons, generally lower population and wage growth. We'll talk about why that's very important in the next few slides here. Generally, the lower economic diversity, lower volume of products, so just less buildings out there, less apartment communities, which really means less options, less exit options for that. So you really need to be careful when you're planning that out on time of exit. Maybe you have some contingency plans. And then you generally have less options for contractors, for management companies, less sophisticated all around, generally speaking, from those services. Which just means that you need to look more heavily at what's the boots on the ground component, really to be managing those services and those contractors. Still great areas. I certainly like them, but and all of these obviously have their pros and cons, but there's just different things to consider based on your return expectations and your risk profile when you're investing.
Yeah, no, that's spot on. You're right in regards to tertiary markets. Yeah, it's going to be more hands-on, maybe a few more visits, but the returns can typically be a little bit better. Where the primary, I mean, a lot of options, but with a little more competition and with more competition, like I said, the returns can sometimes be lower too. So a lot of pros and cons. Looking at the main market drivers, here we look at the demographics, employment and income, housing and demand, and affordability. And we'll break these out one by one. In regards to the demographics, like I said, we're looking at the population growth, the poverty rate, and the crime index. We look at the population growth, we want to see a steady historic growth with reasonable expectations that that's going to continue into the future. So what we can do is look at this from, say, like a 20-year time table and see what the trend has been. And really want to see that 1.25% annual growth year over year. When we look at the poverty rate, we want that less than the national average of 20%, and declining year over year. Just again helps make there be or help for it to become or continue to be a strong market overall. But then we look at the crime index, and again, we want that less than the national index and a downward trend there too. But this is a great spot where we can kind of talk about how not only do we look at a market, but where we can really dive in deep and get closer to that neighborhood scale. when we can look at maps, look at crime maps, and from an address, so we're given an address for a property, and we can zoom in on that and see what that neighborhood is like. You know, we can see how much crime is there. We can see the types of crime. So it gives us a good idea. And you know, we always hear that adage, or you hear people say, on you don't want to be on that side of the tracks. So same thing with you know, buying multifamily, is you want to make sure that you're buying in neighborhoods that are safe, because if you're in a less desirable neighborhood, the tenant base that is there are going to know that, and you're going to have a lot harder time finding the tenants that you're actually seeking for the property that you're buying.
Mhm. Yeah, great points there, Mike. And I think uh, the biggest piece, if you're an LP investor, is making sure that you're thinking to ask that question. Is it in the offering packet that you see? Are they just saying, hey, this is Denver, Denver's crime index is this? Ask, hey, what about what is the neighborhood? What's the suburb? How do those differ, and what are the trends?
Yeah, definitely. And then for the employment side of things, you know, we want to see an unemployment rate of less than 8%, job growth of 2% annually or greater, job diversity. You know, one industry does not account for more than 20% of the of that market, that job market. Although, you know, Brandon's going to give us a great case study of how that may not always be the case, but how you need to know that market. One market that we all know of is Las Vegas, and very hospitality driven. And if something happens to that, there's going to be a lot of people that are banking on a paycheck to pay rent through that. So it's one example. But even if there's a large manufacturer or employer, and they end up having to shut their doors, you know, that's going to have a ripple effect into the housing side of things. First, them being able to pay, and then second, you know, just leaving your units and your occupancy rate decreasing greatly. So it's nice when there is diverse employment opportunities for your tenants. We look at income. We want to see the median household income greater than 50,000, with a wage growth of 2% annually or greater. That growth, the annual growth. So, and we'll have another slide in a little bit, kind of showing you how that can all work and what we look in for that, to make sure that they can afford their rents. But it's important to make sure that you're not trying to get rent on a property where the household just can't afford it. So that's another important aspect to keep in mind as we're going through that.
Yeah, and those are market specific for sure. So a lot of the numbers that were shown up there, these aren't like hard and fast necessarily. It does depend a little bit on what market it is. A lot of them are kind of rules of thumb, and none of them are. We don't look at every single one necessarily individually. We're looking at these things holistically for the market, right? So, and we're looking at what's happening in the economy. These metrics could change as to what our targets are as things change. So, just want to make sure that we're knowing that it's fluid and they're not just hard and fast. It's more, what are the trends? I think the big terms that we saw is the area growing, and is it steady? Are the trends steady? Those are the big things when we think about risk, which is really our focus, is reducing that. Is it growing, and are the trends steady?
Yeah, definitely spot on, Brandon. And like you said, not every box is going to be checked, but like you said, you look at it holistically and see that bigger picture of that market. Yep. We look at housing laws, demand, and affordability. You know, kind of one of the big questions is it landlord friendly? And we got a map as a visual on the right side of your screen. It's a good visual, and both Brandon and I had talked about this map before, and you know, it's not perfect, and there's definitely maybe some flaws in it, but it does give you a general idea of this state by state, and not only state by state, but even down into you know, that community, where maybe it's not rent control across the entire state. Maybe it's city specific. So it can vary there. So you do have to keep on, niching down in deeper into that market. When we look at the median home price and growth, the question there to ask is it cheaper to buy than it is to rent? So when we're, running comps and seeing what we can get for rent on a property after we do our value add, is it cheaper for a tenant to go buy a home than it is to rent? And if that's the case, it can become more transitory for your tenants, where they're just kind of coming into the community, quick rent, and then go buy, which is always great. Definitely always want everybody to own a home if that's their wish. But when you're going to do a business plan, you're going to buy a property in a community. That's just definitely something you want to keep in the back of your mind when doing your full analysis of it. And then, is the market appreciating? So there too, looking historically, we want to make sure that appreciation is occurring on average, so that in addition to the value add that we're doing, that there is also just the appreciation factor occurring. And then when we look at the owner occupied housing rate, what we want there to be more renters than there is housing. Again, you take the population as a whole, and you've got more people that are looking to rent properties than, again, owning. So vacancy rate and trends there too. We want to see less than 10% vacancy. If you're looking into a market where they're historically at, let's just say 80% occupancy, that means there's a fair number of units in the community that are vacant, and you end up having a lot of people making concessions, or property owners making concessions, trying to get people to rent their units. So this is the type where you'll see, sign a 12-month lease and we'll buy you a free flat screen TV, or sign a 13-month lease and get your first month free. Different things like that. So if the occupancy is high, there's a lot of demand, and those just tend to be better markets to purchase in. Here's where we'll look at affordability. And again, the question is can the tenants afford the projected rents? And what we do is we look at the max affordable rent, and that is a third of the median household income on a monthly basis. An example below, you can see in this example just that we, threw out $75,000, and we have an income growth of 2.5%. Then we also look at what we foresee that the projected rents to be. And we want that to be $1,750 with a rent growth of 3% annually. So as you can see, there is a difference between the income growth and the rent growth of 0.5%. And we want to look at that over this planned hold period. And as you can see on the right, or I should say, when you do the math, your max affordable rent is $2,083. So when you look at the year one, we see the max affordable rent, and then we see our projected rent is $1,750. And as you move through there, with the increases in income and increase in rent, when we hit year 5, the max affordable rent is $2,299, where the projected rents are $1,969. So when we're looking at this up front, we can see that we're still well within what their max affordable rent is, which is great. We know we're under by over $300. But what's even more important, or just as important, is that when we look at selling this property, the next buyers will probably be doing a similar analysis. And if they look at this and they're able to see that delta between the two, that's music to their ears, and checks one of their boxes. So not only does it make sense in the front end, but it also does, or continues to, in the back end, which is important.
Yeah, great. And that's it's a really important thing. I think it's always been a really important thing, but just really ask that question, especially over the last couple of years where we've seen such high rent growth and we're seeing that slow down or even go negative. If you're looking at a potential project to invest in, and they're projecting a significantly higher rent growth than what the wage growth is, that's a potential red flag to just ask further questions. So I think it's an important thing for all of us to be looking at.
Definitely. And then here are some of the resources that we look at. So if you are looking at investing into a project, a lot of times through the the presentation that is given on the project, they're not going to have slides on all of this information. There'll be bits and pieces of it that they'll hit on and touch on. But again, we're just giving you kind of that background of what we're doing ahead of time. But you're not going to see it up front. But one thing that's neat is just all the resources that are out there available to all of us online. And these are a lot of the different websites that we go through and look at. When we get down towards the bottom of the list, you see CoStar. This is a subscription base, and it's really expensive to have. Why? Because there's a ton of data. The amount of information that they put in those CoStar reports is amazing, very valuable. But we're able to get those through broker relations. So when a broker has a property listed, we're able to contact them, get those reports, analyze them, and make sure that it hits the rest of the stuff that we were looking up, and even fill some of the gaps that we didn't already have. So great information. Another one is the local chamber of commerce. When you really start getting serious on a project, we want to make sure that we're talking with the local chamber of commerce and what's going on there. They're always more than happy to sit down with you and talk about their community. They are deeply rooted in those communities. They love to see them grow and thrive, and they are more than happy to explain all the stuff that has been going on in the community and what's coming or hoping to be coming. Another one is the planning and zoning department, and I just had a personal experience with that. And I met with the local city planner, and we were able to go through the zoning map and how that has changed over the last year. We were able to look at their comprehensive plan, where he was able to look at where they plan the city to be growing, the areas that there's planned subdivisions, where some of those properties that are zoned multifamily or stuff that they've rezoned to commercial or industrial, and where they're trying to get this stuff all set up. Also including where they're looking at extending utilities, or the utilities that have been extended, planning for that future growth, so that when we're either looking at existing properties or looking at building something, that we know before we start looking for land, that we know where the utilities are, so we're not incurring hundreds and hundreds and hundreds of thousands of dollars of utility costs to get to a property that we may want to buy. So then we can start looking in that area that the utilities are provided or going to be provided to in the near future. So again, just a lot of great resources that we look at. But now I want to turn it over to Brandon. He's got a great example or an overview, a case study of Rapid City, South Dakota, a community that he lives in, a community that we've looked at projects in, and now he's just done a bang up job. So I'll turn it over to you, Brandon.
Yeah, thanks, Mike. Yeah, so this is, like Mike said, this is an example. This is an overview that I've provided to investors, done the research. Obviously, I do live here, but this is the type of thing you should expect if you're looking at a project, regardless of where it's at, that your operators are able to provide to you either in their overall investment summary or just as a standalone, hey, this is the market and why we like it. But we'll go through, show you what I presented and touch on all the different items that we've gone through so far in what we look at and what you as even the LPs should be looking at high level. So,
sorry, Brandon.
Oh, you're good. I forgot I didn't have control of slides there either. So really just an overview of what is the market and where is it? So for me, this is an example of a tertiary market. Like we said, Rapid City is tertiary. It's not overly well known. So we really talk about location of where it's at. So in this case, Rapid City, for those that may not know, we're in Southwest South Dakota. We're kind of isolated, so that's a part of it. That's that tertiary market, but we're 6 hours north of Denver, 8 hours northwest of Omaha and 9 hours west of Minneapolis. And really the claim to fame here is the Black Hills. So Mount Rushmore, the Badlands, all those types of things. So it is a strong tourist economy for sure. It's not the only piece. We'll touch on that, but that's a little bit about Rapid City and kind of where this market sits. So the overall highlights. So this is just a summary of a lot of the things we talked about earlier. MSA population. So we are a smaller market. We're 155,000 and growing. That's for sure. We've had 15% growth over the last decade or so, and peaking up a little bit more. We'll touch more on that. Median home prices for this size of market are higher than you typically would see in a smaller market in the Midwest, and that appreciation has really been growing over the last few years. So that median home price when it comes to rents, that's important, and we'll talk about that again in the future in a few slides. Unemployment rate, super low. We've consistently been one of the lowest in the nation. South Dakota in general as a state, and then Rapid City as the market here, very low unemployment rate, and it's continued to decrease over time. Poverty rate, 12.5%. It's declining, so it's under that 20%. Median household income, 63,000 and growing. It stayed fairly steady. And then our average monthly rent right now is around $1,200 a month and growing at about 3.4% year over year. And then some of the other highlights, these are things you want to look at and things that really make me look at a market. These are, I won't go through each of them, but you'll see some repeats here of business friendly and taxes. Those are the big ones for us. And this is great for investing. Really something to look for when you're investing in any market, because it really drives economy and population growth, right? Those are great things we love to see. So keep an eye out for those.
Oh, sorry, Brandon. But yeah, when I look at the median household income of 63,000 and the median home price, of over 450,000, pushing 460,000, it looks like there's going to be some renters in there.
Yes, some rental growth for sure. Absolutely. All right. Population growth. So like I said, 15% over the last decade. But our local chamber of commerce actually does an annual in-depth housing study. And their most recent, they're projecting an increase in our already increased population growth. So 18-20% through the rest of this decade. It's retained its spot for the second year. This was last year as the fastest growing community in the Midwest. And you can see the plot here on the right of this growth. And you'll see there's a little discrepancy, 76%. That's for the city center itself. That last slide showed 150 for the MSA. You'll see that sometimes, or I'll say often, in these tertiary markets where there's a city center. And like we said, those tertiary markets are a little bit more spread out population center. So careful when you're looking at those. But the overall sentiment is the growth has been going over the last decade. And like we said, we're looking for growth and stability. And we're seeing growth and an increased expectation for growth. And we'll talk about why and some of the validations of that. Economy. So we talked about a few different things with the economy. We want to see diversity. And we want to see growth. So we do have a fairly diverse economy, especially for tertiary market. Rapid City is typically looked at and thought of as a heavy tourism market, and it is. It does provide a lot of our economic drivers there. But we also have healthcare, which is something you really like to see. Healthcare is stable, and there is demand for it, obviously. And we happen to be the only major regional hospital in a pretty large radius here. So that's a great thing. And they're really pushing to grow it. Our second largest employer here is the Air Force Base. So it's a big component here. And military bases, typically you should look at with caution. They can be great drivers. But if they are the main industry, just like any other industry, and they move and bases can be shut down for sure, that's a big concern, right? So we'll talk about why this particular market, that's not a large concern, and is actually a benefit to us. for the foreseeable future. But then you can see there's just a good breakdown here over last pieces here. You can see job trends, little dip over COVID, just like most saw, but continued growth and projected growth, and then unemployment rate, a little bit of a blip there in COVID, but steady decrease, and every sign pointing that it's going to stay low and even go lower. So if you do have something like a military base or a large chunk of your employment base, you want to understand a little bit more. Like Mike said, it's not a deal killer necessarily. It's something you want to ask the additional questions, and you want to make sure any operators that you may be investing with have a good reason for being okay with that. In our case here, we do have the Air Force Base, but there is a large expansion that has been going over the last several years and is expected to continue. Over $1 billion of investment, expected to bring an additional 3,000 service members over the next few years, increase in personnel for employment, and then all the other just indirect, they are bringing in large contractors over the next several years. So lots of jobs to be added, and a good component of our population growth. So with all of the investment being done here, it's all done for the brand new stealth bombers. This will be the main training grounds for the new stealth bombers. So it's very safe to say that this base won't be getting shut down in any near term future. And knowing that this is all going on now, it really drives, in addition to all the other growth. And we'll talk about that in the next slide here. So yes, that's a great driver. I'm very confident that that's going to continue to drive. But the other piece is we want to know that other areas aren't going to be falling and get to the point where that's the only thing that the market depends on long term, even though we're comfortable it's going to stay there. In Rapid City, the Chamber of Commerce and the Economic Development Office are actually, and the state government in general, are really actively working to recruit business to the area, both locally and statewide, like I mentioned. You can see on the left here, biggest job growth is in healthcare. That's a great thing that we like to see. Like I said, healthcare is stable, and there's just active recruitment. Again, no corporate income tax, no personal income tax. All of these things are really helping to drive business here. We actually have, through our Chamber of Commerce, they actually built a large, brand new state-of-the-art facility that can house a few hundred offices. It does house a few hundred offices that they actually use as what they call their business incubator. So any companies that they're recruiting to move their offices to Rapid City, they will actually allow them to come in, set up base in these office spaces, and test out Rapid City for a year before they move to a brick and mortar. And they've been successful with that with several larger companies that have moved over the last few years. So again, these are just things you want to understand. You don't, as an LP investor, you don't necessarily need to go into this level of detail, but you want to understand that your operators that you may be investing in are looking at these types of things to give that level of comfort and just make sure that they're hedging risk. Then we talked about demand. Again, that demand is predicated on population growth, having jobs to support it, and then what's the actual delivery of new units. That's the other piece that needs to be looked at. For Rapid City, we do have obviously that forecasted population growth. And then we look at this plot on the left, and this is really looking at what's been delivered historically, what's projected to be delivered to the market, what's the demand. And we just want to make sure that the supply is not going to outpace the demand. And that's what we're really showing here. Historically, there's the largest demand or deliveries in any given year in Rapid City was 600 units. We're projecting that we'll get more than that, but it is really tough for you to get a whole lot more than that in a tertiary market like this. And our demand, as you can see on those gray bars, is going to certainly outpace it. So all that being said, we know we'll still have strong demand for rentals. We know it'll drive our vacancy to continue being low, and it'll help those rents come up. And then this last piece, just gauging the affordability of the market. I think you majority of the country, and this will be the case, that there's a big affordability challenge when it comes to purchasing a home. Mike, you pointed that out, and that was great. You see in that when our home prices are at 450, especially at interest rates today, and likely for the foreseeable future, that mortgage payment is a lot, and it's generally more than what the median household incomes can support. And that's what this plot shows here for Rapid City. You can see the blue bars there is the theoretical affordable shelter expense, and those orange bars are what it would cost for the median home price from a mortgage rate standpoint. You can see that there's a big gap, and it's growing. For us to actually get back to where this is equal, we would need to stay at the median home price that it is right now and get back below a 3% interest rate, just to be equal, without anything else changing. And that's tough to imagine is going to happen anytime soon. So all that being said, again, just another piece to look at. Is it likely that your rents are going to grow and your vacancies are going to stay low? And this is probably the case for many markets, but not all. And then pricing, this isn't something that we necessarily talked about from a market selection standpoint, but it's all kind of a culmination of all these things. You'll hear the terms cap rates thrown out there. We touched on them in our last webinar, and we'll go a little bit deeper in the next one when we talk about underwriting. But you really want to know what's the forecasted appreciation. That's really what cap rates are kind of telling you what assets will be valued at. And really the main thing for this group is just to know that, are we looking at cap rate expansion, or are they shrinking? And what's realistic for the market? And are your operators projecting more optimistic cap rates from a standpoint? We really like it. Yes, we're showing that cap rates are going up, which means that the properties will be actually worth less in the short term. But when you look out over the 5-year horizon, it is projected that these will actually be coming back down. So we look at these as typically longer investment horizons. So this just gives another level of comfort that any asset you're investing in likely appreciate from a market standpoint, not just from how you operate the property. In this case, the delta that we're seeing over the next 4 years from a forecast could be just purely in cap rate, an 11% increase in value. So nothing to bank on, but again, it's just another metric of how is that market looking from a health perspective, and as an area you might want to invest in.
Perfect. No, great job, Brandon. I always enjoy that presentation on Rapid City, and it checks a lot of the boxes, and it's just a good example of how we do this for other markets too. And again, just being able to see that whole holistic picture of these markets before you just go diving into one and looking for one to buy. So I'm going to stop sharing and just see if I can get to the chat. Perfect. So if you guys have any questions, feel free to plug them into the chat. Hopefully it's working. I did check it earlier, and it did look like we were able to get some questions. So anyways, I want to thank all you for joining us again this evening. This was our second webinar in this series. We'll hopefully do another one within a month, 6 weeks, something like that. We'll look into underwriting, and Brandon is definitely the mastermind of the underwriting and spreadsheets. So he's definitely going to blow our minds with the analysis that is done. So it's really cool to see that. But again, this is recorded. We'll be able to send this out. I know some were joined a little bit later, so if you missed the first part, feel free to take a look at that later on. And if you do have questions after this, feel free to reach out to Brandon or myself. We're more than happy to answer any questions you guys might have. And as always, we love to chat about real estate. So with that, I will say thanks again, and we'll see you at the next webinar.
Yeah. Thanks, Mike. Thanks everybody for joining. And we look forward to seeing you on the next one. And yeah, like Mike said, reach out anytime, whether it's multifamily or otherwise. We love chatting real estate. So
That we
thanks
do.
again.
Thanks.